Right, now this is the second video. The previous one was looking at classical economics. What we now want to look at is Keynesian economics. So we're going to go back to the classical model first of all. What we assumed here was that supply and demand, the free market, the price mechanism, whatever you want to call it, will solve our problems. Okay, so markets will always get to that magic equilibrium point where demand meets supply. Okay, so if the price was too low, what we would know is we would have excess demand, so the market would solve the problem by forcing the price up to get back to the magic equilibrium point. If the price was too high, what we should know is supply is massive compared to demand, so the market price will get forced down to clear the market. Now, classical economists assume that therefore in the long run we will always get to the full output point. In other words, all the resources across the economy will be used. Now, a Keynesian economist would say, hang on, that's not going to happen. Okay, markets may equilibrate in the long run, but Keynes once famously said, in the long run we're all dead. In the short run we might have this horrible situation where we don't have markets clearing. Okay, now that could mean that people remain unemployed for a long time. It could mean that they're never going to get jobs. It could even mean that in the long run we'll still have unused factors of production. Now, with this in mind, we're going to draw the Keynesian model. So for the Keynesian model, again it's the same axes, so real GDP and the price level. But this time, rather than this vertical line we get in a classical world, we're now going to go for this Keynesian LRAS curve. Now, like before, we do have a vertical part of the LRAS curve, and this would again show us the full output point where all factors of production across the economy are being used, the natural state of the economy, if you like, especially in a classical world. But this time, what we assume is the economy can get stuck, it can stall, if you like. I mean that we get stuck here. Look at the problem now. Y1 to YFO. We've got all this spare capacity, a negative output gap, becoming unemployment's really, really high, for example. Okay. Now, remember, in the classical world, this problem was easy to fix. The market would solve the problem. Basically, unemployed people, unemployed factors of production are just things sat on a shelf waiting to be bought, but no one's buying at the current price. Price levels get forced down, that lowers business costs, firms buy more, and the economy will get back to the full output point. Now, in a Keynesian world, that's unlikely, because what a Keynesian economist will assume is that we have something called sticky prices. Okay, imagine someone's unemployed. Well, they may have lost a job working at the minimum wage. They've got no ability to lower their wage rates. Firms that supply resources, commodities, for example, they've got a rock bottom price. They can't go below that price. They're going to be making losses. That could mean they're unable to sell lots of their different factors of production. So, what a Keynesian economist would say is what we need to therefore do is to stimulate the economy. We need to encourage what he will call positive animal spirits, get people confident, get people spending in the economy. So what we do, we boost aggregate demand. How do we do it? Well, we can do it through lower interest rates, which encourage more people to borrow money from banks and spend. Businesses to fund more investment, for example. We could even do it through, and this is a really common approach, through fiscal policy. Boost government spending, lower taxes, just anything to get people spending across the economy. What we would therefore, hope this would do is to lead to multiplier effects. So spending to create spending across the economy, which could mean the economy grows by more than the original injection into the economy. But what happens now? That boost to aggregate demand will lead to a growth in output. But the difference this time is we haven't got a huge increase in inflation. Now the idea will be, and this is where this horizontal part of the LRAS curve comes in, the further to the left we get from YFO, the smaller the impact will be on inflation of a growth in aggregate demand. The idea is the bigger the negative output gap, the less less scarce resources are, so high demand shouldn't really boost prices. Okay. Now, what we would though be a little bit careful of. Imagine aggregate demand started here. We can see here that we're operating on YFO. All resources are being used. Well, if you were to boost aggregate demand further, there are no spare resources to produce more output. Everyone that wants a job's already got one. Every resource that's being used, it's been used. There's nothing spare. Okay, so with higher demand will literally fuel more demand for the same resources. Firms can't keep up with order books, and will lead to big growth in the rate of inflation. Okay, so Keynesian economists is basically all about boosting demand to get as close to YFO as possible. This, of course, is in contrast to a classical world where we let supply and demand solve the problem.